Welcome back, everybody. Today we're analyzing Salesforce. They are a large company, $264 billion company. This is their 5-year chart. It's pretty crazy. They're way up and then way down. Very volatile chart. And over the past 5 years, they returned 70%, which is lower than the S&P 500. But you know what? We're seeing this dip here. And you know what? I see this as a buying opportunity, to be honest. So let's discuss why I feel that way. All right. They have a price to earnings ratio of 70, but that is very misleading, and we'll see why. Let's go to their financials here. Statements. Look at this revenue growth. Absolutely stellar revenue growth. They had plus 30% last year, and they're guiding for plus 10% next year. I definitely think that they could do 10%, maybe even higher. So that is super good to see. Also, look at this gross margin. Gross margin is super high at like 70%. About, yeah, 70%, and translates fairly well into operating income, although they do have a lot of operating expenses with like engineers, like R&D, and then selling, but still pretty good margins. And if you actually look at their cash flow, which is crazy, they actually had almost 10 billion in cash flow last year, which is so high. And if you actually use cash flow instead of earnings, then their cash flow to price ratio would look more like a 27, which actually seems kind of cheap for this business because of how quality this business is with its networking effects and whatnot. So what else did I want to see? Okay, yes, their balance sheet is amazing. Negative 632 million in net debt, so nothing to worry about on the balance sheet. Back to the cash flow statement. Let's see what they're doing with all their money. And it looks like they bought back tons and tons of stock last year. They bought back 5.6 billion in stock, and they also paid off some debt last year. So really, really good to see those things. Retirement of stock, I mean, there's pluses and minuses to it, but I'd say it's probably good, especially since they were probably issuing a lot of stock-based compensation. Then they're probably just buying that back. So let's check out the stats really quick. Their ROIC is actually not very good, which is weird. Not really good to see that. Although they don't really have the last couple of years listed. In terms of gross margin, yeah, super, super good gross margin. Operating margin has actually come up quite a bit. I think probably the reason why their operating margin used to be so low is because they spent a lot of money on marketing. But then once their revenue becomes so high, they don't need to spend a proportionate amount on marketing. And that's when you see the operating margin really explode. And that translates straight into their net margin. And I do expect these margins to increase quite substantially in the future. So let's take a look at some of these earnings reports. So this is all their different services. It's pretty crazy how many services they have. Sales, service, platform, and other market. They've got a lot of different products. I took a look, and it's like insane the amount of products that they offer. Sales, service, platform, and other. Those are their three biggest, and then they've got their marketing and integration. Like they've got like this is pretty even split. That's what I wanted to show there. Pretty even split between those. And they make most of their money in the Americas and Europe, and then they have a small market in Asia Pacific. They're guiding for 37 to 38 billion, which is a 9% increase over the year over year. And this is the growth that they're seeing. So they're seeing 11, 12, 11, and 20% in their integration and analytics. Overall, they're seeing a 12% increase in their revenue. And then they've also got these three businesses, which are also increasing in revenue. So increasing all across the board. You really love to see that. Let's take a look at their statistics here. Their short percentage, which can be a good indicator. They're only 1% sold short, which is really, really low. And that is a total green flag. Let's take a look at the analysis page and see what the analysts are expecting. So the analysts are expecting these numbers, 40 billion in revenue for 2025 going up to 42, which is a 10% increase. I like to use these numbers for my discounted cash flow model. Let's take a look at that. All right, so I put the estimates in my yellow boxes where I like to put them. They're also estimating 10 billion in buybacks next year, which is a lot of buybacks. And do expect that to drive the price share or the share price up in the coming year. Net debt negative. Discount rate of 10% because I want a 10% return on all my stocks, and an exit multiple of 22 because this company has such wide networking effects. It really contributes to a moat that they have. And so they can continue to grow basically indefinitely into the future. They have massive pricing power. And so that's why they deserve an exit multiple of 22, maybe even higher at like 25. In terms of earnings growth, this is what I put down for earnings growth 15%, 10%, and basically leveling out at 8%. I think that's totally fair for this business. And in this case, they are slightly overpriced at 272 currently. This is saying that they're worth 256. But it's not too bad for such a high quality business. I really don't see too much downside with this company. In terms of the earnings model, this is what we have. We have profit margins of 24%. That is what that's what they're guiding for basically, is 24% margins. Seems high based on their past results, but I do think that they can hit that. In terms of growth, they're expecting 10% revenue growth into 2025. That's what I put there. And I think that they're going to continue to grow at a 10% clip. I don't really see any reason why they wouldn't be able to grow at a 10% clip. They have massive pricing power. They're just going to keep getting new users to their platform, and they sell a lot of different products. So yeah, I think that they're easily going to hit this. In terms of profit margin, they could definitely expand their margins past 24% as well. So like they did 10 billion in cash flow last year, or 9.5, which is like a 28% margin on their cash flow. So that's why I think that they can easily do 24% profit margin, is because they've already done it in terms of cash flow. And so if we like right here using this scenario, which I think is probably the most likely scenario, you're looking at $246 for a fair share price. Although I really think that they could expand margins. So if they expand margins up to 28%, and then based on like their revenue growth and they spend less on marketing, they could probably get up to like 32% eventually. In the case that they make it up to 32%, they are a buy right now. Fair share price being 320. Also, I think the exit multiple 22 may be a little bit low for this business because they have basically infinite growth into the future. We'll say exit multiple 25. And here we're looking at a fair share price of $350. If you bought them today, you'd probably be expecting about not quite a 15% return, maybe a 14%. Yeah, I'd say if you bought them today, you'd be expecting a 14% return. I do think that this is one of the higher quality businesses that you could buy at this current moment. And that is my conclusion. I hope you guys all enjoyed. If you did, hit that like button. Also, let me know anything or like any of your thoughts in the comments. I always love to hear criticism or anything you guys thought of during the video that I could improve on or that you have ideas on. So let me know in the comments. Also, if you want to try this spreadsheet, just check the link in the description. You can try it completely for free. I just made it myself using the free tools. And yeah, you try it out, and I'll see you in the next video. Peace.